All right, let's dive right in. Today we're talking about a really fundamental and kind of surprising shift that's been happening in the world of fintech. While all of us have been looking at the big, shiny headlines, these companies have been quietly growing up. And their latest earnings reports, they revealed something huge.
Exactly. This wasn't just, a good feeling or some positive market sentiment. No. This was real, hard, numbers-driven change. We are officially moving past the hype-fueled era of just endless growth promises. The conversation isn't about potential anymore, it's about actual performance. What we're seeing is a real graduation.
And this slide? This is the heart of it, right here. The whole 2021 playbook of just get more users and expand the total addressable market, that's out. The new 2025 playbook is all about the stuff that actually builds a lasting business. Solid cash flow, fixing your profit margins, and get this, even returning cash to shareholders. And to really see how this is playing out, we're going to look at 3 amazing company stories. Okay, first up, Dave. Now, I bet a lot of you remember Dave as a very, very specific kind of app. But believe me, the company has gone through a massive transformation. That's right. The old perception was, oh, Dave, that's the app for getting a quick $50 to make it to payday. But that's the old story. The new Dave is a way more sophisticated platform. It's totally focused on building a stable cash-generating machine and, here's the kicker, rewarding its investors. And a huge piece of that puzzle is a word you probably wouldn't have associated with a company like this: buybacks. So let's be clear, a share buyback is a massive, massive signal of confidence. It's the management team basically shouting, hey, we're generating real, durable cash, and we think the best investment we can make right now is in ourselves. For a company that was once just seen as a risky little app, this is a profound shift, both psychologically and strategically. It's the ultimate sign they've left the startup phase behind. And look, this didn't just happen by magic. This newfound confidence is built on a foundation of real operational grit. Dave got way smarter with its underwriting, so it's taking better risks. Its customers are sticking around longer, which is huge, and its revenue is becoming way more predictable. This is the tough, not-so-glamorous work of building a real, sustainable financial company. And I just love this analogy because it's perfect, right? It captures the vibe of the transition so well. It's the same company, the same character at its heart, but it has seriously leveled up. That chaotic or figuring it out as we go energy has been swapped for genuine competence. It's a true corporate glow-up. All right, let's move on to our second case study, and you'll see how this theme builds. We're talking about Riot platforms. Now, when you hear Bitcoin mining, you probably get a very specific picture in your head. I need you to just take that picture and throw it right out the window. Because, yeah, the old Riot really was just seen as a bet on crypto. A meme stock, basically, just riding whatever the latest hype cycle was. The new Riot? It's something else entirely. It's an industrial-scale energy company. The Bitcoin it mines is almost becoming a byproduct of a much bigger, much more interesting energy strategy. And the numbers? The numbers absolutely back this up. Over $647 million in revenue. Come on. That's not meme money. That's not a flash-in-the-pan number. That is serious industrial-scale revenue that requires massive infrastructure, planning, and execution. And this is how they're doing it. This is the core of their new business. They've become absolute masters of the energy market. They're making money off of complicated power contracts, earning credits from the state for powering down during peak demand. They're literally helping build out the power grid in Texas. Mining Bitcoin is just one piece of this massive energy puzzle they're solving. This just nails the cultural shift. The party's over, folks. The speculative, neon-soaked frenzy of 2021 has given way to the hard-hat reality of 2025. Riot traded its glow sticks for steel-toed boots, and it's focused on building something real. Okay, for our last case study, let's head down to Brazil and talk about StoneCo. Now, this is a company that took a completely different and, honestly, a pretty counterintuitive path to get back on track. So, StoneCo's journey has been a real roller coaster. For a while, it was the darling of growth investors, expanding like crazy into new things like lending. But then, in 2022, that all came crashing down. The strategy backfired, and they got slammed with huge losses. So the last couple of years have been about a painful but totally necessary reset. And it's working. Profitability is way up. Their whole strategy is this idea of shrinking to grow. Now, I know that sounds like a total contradiction, but the logic is actually rock solid. You cut away all the distracting side projects, all the low-profit experiments, so you can pour every ounce of energy and every dollar back into the core business that actually makes you money. It's about being focused, not flashy. And honestly, is there a better way to put it? StoneCo went through its entire business and asked that one simple question: does this spark margin? If the answer was no, poof, it was gone. It's the corporate version of decluttering your house, and it's making the whole company leaner, meaner, and way more profitable. So let's zoom all the way out. We've just looked at three totally different companies, right? A cash advance app, a Bitcoin miner, and a payments company in Brazil. But if you look closely, their stories are all pointing in the exact same direction. I mean, look at it all laid out like this. The pattern is just undeniable. Dave went from a simple app to a company returning capital. Riot went from a crypto meme to a serious energy company. And StoneCo gave up on growth at all costs to laser focus on high-margin operations. This, my friends, is the new era of capital discipline. And that right there is the big takeaway. Success in fintech isn't being measured by vanity metrics anymore. Nobody cares about just user growth or how big your TAM is. What matters now is cash flow, a strong balance sheet, and just a relentless focus on being excellent at what you do. Fintech didn't die, it graduated. So that leaves us with this final thought. The world of fintech is starting to sound, well, a lot more like a boring industrial company's earnings call than a slick startup pitch deck. And while boring might sound bad, it might actually signal a much healthier, much more sustainable, and at the end of the day, a much more valuable future for the entire industry. So what do you think that means for the next wave of innovation? Thanks for joining me.